Right now, I mean, the average American home costs roughly $500,000.
Yeah, which is just a staggering number.
It really is. I mean, it's locking an entire generation out of the housing market completely.
Absolutely.
But today we're looking at a company that is actively building brand new 3-bedroom homes for $185,000.
Right, which sounds almost impossible in this market.
Exactly. And on top of that, they are sitting on this absolute fortress of a balance sheet with hundreds of millions in cash.
Yep.
They have aggressive macro tailwinds. They've got, bipartisan government legislation blowing right at their backs. And yet, despite all of that momentum, their profits just dropped 12%.
Yeah, it's wild.
Yeah. So welcome to this deep dive. Today, we are tearing into the Q3 fiscal 2026 earnings call for Champion Homes. That's ticker symbol SKY.
And it's quite the story.
It really is. So our mission today is to figure out how a company that is basically dominating the affordability crisis manages to grow revenue, right, while watching its earnings per share just slide backward. And more importantly, what this actually means for you if you're holding or even just considering the stock.
Well, I got to say, it is probably one of the most fascinating earnings transcripts I've read this entire quarter.
Really? Just because of that contradiction?
Precisely because of that contradiction. I mean, on the surface, you have this housing market that is just screaming for supply, right?
Desperately.
And you have a manufacturer that is perfectly positioned to provide it.
Right.
But then when you look really closely at the financials, you start to realize that building homes in factories and navigating this current macroeconomic environment is incredibly complex.
It's not just a straight line to profit.
Exactly. The true narrative for Champion Homes this quarter, it isn't just about the top-line demand for affordable housing.
Okay, so what is it about?
The real story is entirely hidden within their margin structures, the drastic strategic shifts they're making in their sales channels, and honestly, an incoming wave of liquidity that could fundamentally alter their valuation.
Okay, wow. So I want to get straight into the friction here. Let's look at the headline numbers, and let's start with the top line.
Let's do it.
So for the third quarter, Champion Homes reported net sales of $657 million.
Right.
And that represents a 2% increase year over year. And if you isolate just their U.S. factory-built housing revenue, that also ticked up by exactly 2%.
Yeah, I did.
So, I mean, money is coming in the door faster than it was 12 months ago. Growth is technically happening.
Yes, the top line is expanding. But, if you're analyzing this business, the top line really only tells you about the scale of the operation.
Right. Not the actual health.
Exactly. It doesn't tell you about the efficiency or the profitability of it.
Right.
So we have to travel down the income statement to the bottom line.
And that's where it gets messy.
That is where the picture immediately gets muddy, yeah. Net income attributable to Champion Homes came in at $54 million.
Which, okay, in isolation sounds pretty robust.
Yeah.
I mean, $54 million in profit for a single quarter of operation, that's not nothing.
No, it's substantial. But you have to remember, the market prices companies on earnings per share.
Right.
And when you translate that net income down to EPS, it comes out to 97 cents per diluted share.
Oh.
Yeah. And that figure represents a 12% decrease year over year.
Wow.
Furthermore, if you look at their adjusted EBITDA, which, strips out taxes, depreciation, and those accounting anomalies to give you a pure look at cash profit.
Right, the core operations.
Exactly. That came in at $75 million, which is a 10% drop from the prior year.
Okay, so I'm looking at these numbers, and my immediate reaction as an investor is just intense skepticism.
Naturally.
Like, how does a company grow revenue by 2%, pull in $657 million in a single quarter, and somehow end up with an adjusted EBITDA that is down 10%?
Yeah.
And an EPS that has fallen off a cliff by 12%? How does that math work?
Well, the mechanism driving that discrepancy is margin compression.
Okay.
Specifically, their gross margin took a really significant hit. For Q3, Champion's consolidated gross profit was $172 million, and that represents a gross margin of 26.2%.
Which, wait, that's a 190 basis point drop from last year, right?
Exactly. Almost 2 full percent.
They essentially lost nearly 2 full percentage points of profitability on every single dollar that came through the door.
Yep, they did.
My instinct is to just hit the panic button when I see margin decay like that in a manufacturing business.
Oh, for sure. Anyone would.
But the weird thing is, when you read the transcript, the internal team seems kind of calm about it.
They really do.
Like the outgoing CFO, Lori Hu, she actually noted on the call that this 26.2% margin came in slightly better than their internal expectations.
Which is a really critical detail. I mean, Wall Street algorithms might sell off on a 190 basis point contraction.
Sure, the bots just see the drop and sell.
Exactly. But the operators inside the building, they modeled for a worse outcome.
So they saw this coming.
Oh, they saw this squeeze coming from miles away.
But why? I mean, if management knew the margin was going to deteriorate, they must have seen structural headwinds in their specific pipeline.
Yes, absolutely.
So what exactly is driving this squeeze?
Well, to understand the margin decay, we really have to dissect the core dynamic of any manufacturing business, which is the relationship between volume and price.
Okay, so how many units they push out versus what they charge?
Precisely. How many physical units did they push out the factory doors, and how much did they charge for them?
And the volume data is where things actually start to crack, isn't it?
It is. The actual number of U.S. homes sold in the quarter dropped.
Right.
Champion delivered 6,270 units, which is a 3% decrease compared to the third quarter of last year.
Okay, but look at the pricing side of the equation.
Right, the ASP.
Yeah, the average selling price for a U.S. home increased by 5%. So the average price they commanded per home this quarter was $99,300.
Which is key. So there is the math behind the revenue growth.
Right. They sold 3% fewer units, but they charged 5% more for the ones they did actually sell.
Exactly. The price hike basically absorbed and ultimately outpaced the volume drop.
Which allowed the total revenue to squeak out that 2% gain.
Right.
But the real question for me is why volume dropped in the first place, especially in an environment where literally everyone is screaming for affordable housing.
Yeah, it seems counterintuitive.
It really does.
Right.
Now, management pointed to two main factors, and the first one was the weather.
Correct. They cited a tough year-over-year comparison that was heavily influenced by weather patterns.
Okay, I have to stop you there and push back a little bit.
Sure.
Because whenever I hear a management team blame the weather on a quarterly earnings call, my eyes instinctively roll.
It's a classic excuse.
Yeah, it feels like the ultimate corporate scapegoat. Like, oh, the sun didn't shine, so our volume dropped.
Yeah, the dog ate my homework.
Exactly. And in a factory-built house-up model, where the entire value proposition is that you build indoors away from the elements, how on earth is weather a legitimate excuse for a 3% volume drop?
Well, your skepticism is totally warranted. And honestly, in many industries, weather is just a convenient excuse. But in the off-site manufacturing sector, the logistics dictate a very different reality.
Okay, how so?
Yes. The homes are built in climate-controlled factories.
Yeah.
And that absolutely protects the manufacturing phase.
Right, the building part is fine.
But a factory-built home is completely useless until it is actually delivered and installed.
Oh, right. You have to move it.
Exactly. These are massive, wide-load structures that have to be transported via highway. They often require pilot cars, specialized hauling equipment, the works.
Which means they're heavily regulated by state highway departments.
Spot on. If there's ice, if there's heavy snow, or even high wind, highway patrols will halt wide-load transports.
Wow, so the home literally cannot leave the factory lot.
It's stuck. Furthermore, the final destination, the physical site, that has to be prepared too.
Right.
The foundation has to be poured, the utilities trenched, the ground leveled.
And you can't do that in a blizzard.
Exactly.
Yeah.
If you have extreme weather saturating the ground, the on-site crews cannot prep the pad, and the cranes cannot safely set the home.
Okay, so the bottleneck isn't the factory floor at all. It's the highway and the destination dirt.
Precisely. And what happened last year was that bad weather in Q2 delayed a massive number of deliveries and installations.
Okay.
Those delayed sales eventually closed, but they got pushed into Q3.
I see.
So last year's third quarter had this artificial, unnatural spike in volume.
Got it. So when Champion compares this year's normalized Q3 against last year's inflated Q3, the volume looks like it contracted.
Exactly, when in reality, they're just comping against an anomaly.
That actually makes sense.
Yeah, and you add to that a few localized weather delays in the current quarter that cost them production days, and the volume drop really makes mechanical sense.
Okay, fair enough. I buy the weather comp. The logistics of moving a 1,600 square foot structure down a highway definitely validate that argument.
Yeah, it's not like shipping a laptop.
Right. But the weather wasn't the only thing dragging down volume. The second factor they cited was a deliberate pullback in their community REIT channel.
Yes, and this is where we shift from logistics to macroeconomics.
Okay, break that down for me.
So The community REIT channel represents those large institutional operators who own manufactured housing communities.
Right, the trailer park owners, for lack of a better term, but modernized.
Exactly, institutionalized communities. These operators buy homes in bulk from champion to place on their leased lots, generating returns through lot rent and home leasing or sales.
But wait, if housing is at such a premium and affordability is the biggest crisis in America right now, shouldn't these REITs be buying these homes hand over fist to fill their communities?
You would think so.
The demand from the end consumer is clearly there. Why are the institutional buyers blinking now?
Because institutional buyers operate on very different capital expenditure cycles than individual retail buyers do.
How do you mean?
Well, these REITs are looking at a very cautious consumer right now, and they're dealing with a volatile interest rate environment themselves. If an institutional operator borrows money at elevated rates to buy, say, 100 homes from Champion, they need absolute certainty that they can immediately fill those homes with paying residents to cover their carrying costs.
And right now, that certainty just doesn't exist.
Exactly. The end consumer might want the home, sure, but if that consumer is struggling to secure financing or is hesitant to commit due to economic uncertainty,
the REIT isn't going to take the inventory risk.
Exactly. They are pacing their capital expenditures, they're tapping the brakes, preferring to wait for macroeconomic clarity rather than front-loading inventory on their lots.
So the wholesale buyers are effectively pausing to see what the retail buyers do, forcing Champion to absorb the slowdown in that specific channel.
That's exactly what's happening.
Okay, but let's flip the equation. If volume took a hit, what drove the average selling price up 5% to that $99,300 mark?
Two strategic shifts. First, Champion noted a distinct product mix shift toward more multi-section homes.
Okay, and these are the homes that are shipped in 2 or more separate sections and bolted together on site, right?
Yeah, exactly.
Creating a larger, more traditional footprint compared to just a single section home.
Right. And a multi-section home inherently commands a higher average selling price. It requires more materials, more factory time, and a way more complex installation.
Makes sense.
So simply selling a higher ratio of multi-section homes mathematically pulls the aggregate ASP upward.
Okay.
But the much larger, far more consequential driver of the price increase is their captive retail strategy.
Yes. This is a crucial piece of the puzzle for anyone analyzing this stock. Champion Homes isn't just a manufacturer selling to third-party independent dealers.
No, not at all.
They actually own and operate their own retail storefronts. They are entirely vertically integrated in this channel.
And that captive retail channel is accelerating rapidly. This quarter, captive retail accounted for 38% of their total consolidated sales.
Wow.
Yeah. And that is an increase from 35% in the exact same quarter last year.
I mean, a 3% shift in channel mix might sound incremental on paper, but when you are talking about hundreds of millions of dollars in revenue, a 3% pivot toward direct-to-consumer sales is a massive strategic realignment.
It is completely transformative for their cash flow profile.
Yeah.
And this shift was heavily accelerated by their recent acquisition of Eisman Homes, which drastically expanded their physical retail footprint.
Right.
The mechanics of captive retail completely alter the margin profile on a per-home basis.
How so? Walk me through the mechanics.
Sure. So when Champion sells a home to an independent dealer, they capture the manufacturing margin.
Okay.
The dealer then marks up the home and captures the retail margin.
Or the dealer makes their cut.
Exactly. But when Champion sells a home through their own captive retail lot, they capture both. They eliminate the middleman and keep the entire pie.
Which directly inflates the average selling price on their income statement, because they are recognizing the final retail price paid by the consumer, not just the wholesale factory price.
Exactly. Capturing that retail premium is exactly what drove the ASP up 5%.
But wait, this brings us to a massive contradiction.
Uh-oh. Let's hear it.
If they are keeping the whole pie at their captive retail stores, and captive retail is growing as a percentage of their overall sales, why on earth did their overall gross margin drop by 190 basis points?
Yeah, it's a great question.
Like, why did total profit fall 12%? If you are cutting out the middleman, your margin should be expanding, not contracting.
And this is the crux of the quarter, right here.
Yeah.
It all comes down to a financial reality called fixed cost absorption.
Okay, let's break this down mechanically, because I feel like it is the single most important concept for understanding their current profitability.
It really is. So think about the mechanics of operating a massive manufacturing facility.
Okay.
Whether you are building automobiles, semiconductors, or factory-built homes, you have fixed overhead costs that simply do not change based on your daily output. You pay the exact same property taxes, the same industrial insurance premiums, the same facility maintenance costs, and the same salaries for your core management team, regardless of whether you build 10 homes a week or 100 homes a week.
Basically, the structural costs of just keeping the lights on and the doors open.
Exactly. Now, in the third quarter, Champion's manufacturing capacity utilization sat at just 59%.
Let that sink in for a second.
Yeah.
Their factories were operating at 59% of their total capacity.
Yep.
That means 41% of their manufacturing capability was essentially sitting idle.
Exactly. And when you run a factory system at 59% capacity, those fixed overhead costs we just talked about are spread out over significantly fewer units.
Oh, I see where this is going.
Let's use some simple math. Say a factory costs $100,000 a month just to operate before buying a single piece of lumber.
Okay.
If you build 100 homes, each home carries $1,000 of that overhead burden.
Right.
But if your volume drops and you only build 50 homes, suddenly each home has to carry $2,000 of that overhead burden. The cost to build each individual unit skyrockets purely because of the inefficiency of the idle capacity.
So the factory inefficiency from the lower volume is literally cannibalizing the extra profit they're making on the retail side.
That is exactly what is happening. The fixed cost deleverage is eating the retail margin alive.
That's rough.
And that is only the first half of the squeeze.
There's more.
Oh, yeah. The second half is raw material inflation. Management noted that manufacturing material costs were higher during the quarter.
So not only is the overhead burden per home higher, but the physical inputs, the lumber, the steel framing, the drywall, the copper wiring, all of that costs more too.
Yep. And crucially, those material cost increases outpaced the price hikes Champion was able to pass on to the consumer.
Wait, why not just raise the prices further? If lumber and steel go up, you just raise the MSRP of the home, right?
Well, normally, yes. But remember that cautious consumer we discussed earlier.
Right.
There is a ceiling to pricing power in the affordable housing sector right now. If you push the price too high, the consumer simply walks away. Or they fail to qualify for financing entirely.
Makes sense.
So Champion had to absorb some of that material inflation themselves to keep the product moving, which further compressed the margin.
Okay, so lower volume leads to terrible fixed cost absorption, and raw material inflation eats into the remaining margin because they can't raise prices fast enough without just killing demand entirely.
Exactly.
That fully explains the 12% drop in earnings per share.
It really does. It is a textbook margin squeeze.
But, despite that squeeze, when you look at the actual products they're delivering to the market, it is impossible to ignore the sheer size of their competitive moat.
Oh, absolutely.
I mean, yes, their costs went up, and yes, they are facing margin pressure. But they are operating in an entirely different universe than traditional home builders.
They really are. They're completely isolated from the traditional pricing paradigms of the housing market.
Yeah.
Management highlighted this perfectly on the call when they discussed the launch of the Emerald Sky home.
Yes. They debuted this model at the Louisville Manufactured Housing Show, and the specifications on this product are just incredible when you place them in the context of the broader real estate market.
Exactly.
So the Emerald Sky is a 1,600 square foot home. It features 3 bedrooms, 2 bathrooms, and this really modern, high-end design aesthetic that actively sheds the historical stigma of manufactured housing.
Right. It doesn't look like what people think of when they hear mobile home.
Not at all. And the targeted retail price for the consumer, approximately $185,000.
Which honestly, even when you factor in the additional costs of acquiring land and pouring a foundation, it represents just an insurmountable affordability advantage over site-built construction.
It is an absolute canyon of an advantage. Let's really ground this in reality for you listening.
Please do.
The average selling price for a new site-built home in the United States right now is hovering around $500,000.
$500,000.
$500,000. Champion is stepping into that exact same market with a brand new, efficiently designed 3-bedroom home for $185,000. Yeah.
A consumer could purchase a piece of land in a secondary or tertiary market, pay for the site preparation, have this home delivered and installed, and still come out hundreds of thousands of dollars below the national average for a new build.
Exactly.
This is no longer just an alternative housing product for a massive segment of the American middle class. This is a survival raft.
That price delta is exactly Champion's ultimate product moat.
Right.
What is happening fundamentally here is an expansion of their total addressable market.
How so?
Well, historically, manufactured housing served a very specific demographic.
Right.
But because traditional site-built homes have become so prohibitively expensive, a completely new tier of consumers is being forced to explore off-site built solutions.
Interesting.
Champion CEO Tim Larson specifically noted on the call that they are seeing new consumer profiles entering their showrooms.
Wow.
Yeah, people who have simply been priced out of traditional real estate and are discovering that manufactured housing is literally their only viable path to homeownership. That's fascinating. The product clearly works, and the market desperately needs it. So how does management see this playing out in the immediate future?
Well, let's look at their guidance for the fourth quarter.
Yeah, what are they telling the street to expect?
Dave McKinstry, the incoming CFO, outlined their Q4 expectations. From a top-line perspective, they are projecting revenue to be up in the low single digits year over year.
Okay, so they expect to maintain the current trajectory, just slow, steady revenue growth.
Exactly.
But what about the profitability? Is the margin squeeze going to alleviate, or are things going to get worse before they get better?
For short-term investors, the guidance on margins is likely going to be pretty frustrating.
Uh-oh.
Yeah. Gross margin is projected to step down slightly again in the fourth quarter.
Really?
Yep, landing somewhere in the 25% to 26% range.
Wow. Remember, they just printed a 26.2% gross margin this quarter, which was already a 190 basis point drop. Now they are telling us it is going to drop again, potentially all the way down to 25%. If revenue is continuing to grow in the low single digits, why are the margins continuing to bleed out?
The continued compression is really driven by a confluence of seasonality and a very deliberate strategic shift in how they manage their working capital.
Okay, let's start with seasonality. What's going on there?
Well, the fourth quarter encompasses the deep winter months.
Right.
Historically, this is just the slowest selling period in the entire housing industry. Foot traffic on retail lots drops significantly.
Nobody wants to go house shopping in a blizzard.
Exactly. Furthermore, management is explicitly baking in the potential for extreme winter weather disruptions.
Ah, the weather again.
Yep. Which, as we discussed, halts both the highway transportation of the homes and the on-site installation, directly impacting their ability to actually recognize the revenue.
Okay, so they are padding their margin expectations against the likelihood of winter storms freezing their logistics chain. That actually makes sense.
It does.
But what is this deliberate strategic shift you mentioned?
It revolves completely around their inventory strategy. Champion is purposefully executing an inventory build at their captive retail locations throughout the fourth quarter.
I read this in the transcript, and I really have to play devil's advocate here.
Go for it.
Management literally just admitted that the consumer is cautious and that foot traffic is naturally slower in the winter.
Right.
So why on earth would they intentionally tie up massive amounts of working capital to build homes, ship them to their own retail lots, and just leave them sitting there gathering dust?
It sounds crazy, right?
It does. If demand is soft, shouldn't you be running a lean, just-in-time inventory model to protect your cash flow?
If you view it strictly through the lens of fourth quarter cash flow, it looks horribly inefficient.
Right.
But if you connect the inventory build to the actual macroeconomic reality of the consumer, it is a brilliant strategic maneuver.
How so?
They are not building inventory for the winter. They are stockpiling ammunition for the spring selling season.
Ah, kind of like prepping the shelves before Black Friday.
Precisely. Let's look at the psychology of the current home buyer.
Okay.
They are cautious, they are hyper-aware of interest rates, and they are taking much longer to make purchasing decisions.
Yeah, everyone is stressed right now.
So when that cautious consumer finally reaches a tipping point in April or May and decides they are ready to buy, they do not want to walk into a retail center, point to a floor plan, and be told, great choice, we will put that into the factory queue, and we can have it manufactured, shipped, and installed in 4 to 5 months.
Yeah, in this environment, a 5-month lead time gives the buyer way too much time to back out, or for interest rates to shift and completely ruin their financing.
Exactly. Champion understands that to close the sale with a hesitant consumer, they need immediate availability.
Right.
The buyer needs to walk onto the lot, physically walk through the home, fall in love with the layout, and hear the sales rep say, you can buy this exact home today, and we can deliver it next week.
That's a huge selling point. It's everything. So Champion is willingly absorbing a short-term hit to their margins right now because running factories to build inventory without an immediate consumer sale absorbs cash, labor, and overhead in order to position themselves to capture peak demand the very moment the weather warms up.
This highlights a really crucial distinction in how we analyze inventory. Because, a company experiencing an inventory build because their product isn't selling is a massive red flag.
Always.
But a company executing a strategic inventory load to prep their own vertically integrated retail channel for cyclical demand is investing in future market share.
Right.
It is the fundamental difference between sell-in and sell-through.
Yeah.
Right now in Q4, Champion is focused on sell-in loading their own bases.
Exactly.
They are betting heavily that the sell-through to the end consumer will actually materialize in the spring.
Which is a bet they can afford to make because of their balance sheet. But it does come with immediate costs.
Right.
Management also noted that SG&A selling, general, and administrative expenses will tick up slightly in Q4. What is driving the SG&A increase? Is that just inflation on corporate salaries or what?
No, it is directly tied to the commercial calendar.
Oh, really?
Yeah. The fourth quarter is heavily front-loaded with major industry trade shows like the Louisville Manufactured Housing Show we just mentioned and the International Builders Show in Orlando.
Right.
These events require significant capital outlays. You have to transport the physical homes, secure massive booth footprints, fly in your sales teams, entertain clients.
But those shows are basically the lifeblood of their independent dealer network.
Exactly.
That is where the independent lot owners and the community REIT operators come to see the new floor plans and place their bulk orders for the rest of the calendar year.
Right.
You literally have to spend the SG&A cash in Q4 to secure the wholesale pipeline for Q1 and Q2.
Exactly. It is just another example of absorbing a short-term cost for a long-term strategic advantage.
Got it. Okay, before we move to the final analysis, there were a few corporate housekeeping notes on the call that we really should quickly contextualize. First, the CFO transition from Lori Hu to Dave McKinstry seems completely orderly.
Very smooth, yeah.
Hughes is retiring after 2 decades of navigating the company through massive industry shifts. And McKinstry, who came on board in January, brings a deep background in consumer products and heavy manufacturing.
Yes, the succession planning appears completely seamless.
Which is always nice to see.
Definitely. The board also elected Ton Kelly as chair, providing continuity and governance.
Good.
But on the operational front, there was a highly positive update regarding supply chain logistics, specifically surrounding tariffs.
Oh, right, the tariffs.
In previous quarters, management had expressed concern that escalating material tariffs could pose up to a 1% headwind on total costs.
Which, honestly, in a low-margin manufacturing environment is a massive hit to profitability.
It's huge.
Yeah.
But during this quarter, they confirmed that the actual impact of those tariffs came in well below the 1% threshold.
Oh, wow.
Yeah. The supply chain and procurement team successfully navigated the international trade friction, sourcing materials efficiently enough to dodge what could have been a pretty severe margin penalty.
That is a real testament to the scale and sophistication of their procurement operation.
It really is.
Okay, we have dug deep into the mechanics here. We've explored the volume drops, the weather logistics, the brilliant mechanics of the captive retail channel, the pain of fixed cost absorption, and the strategic inventory loading.
We've covered a lot.
It is time to pull all of these threads together. Let's get to the bottom line.
Let's do it.
We are synthesizing this data to deliver a clear verdict on Champion Homes based on this quarter's performance.
Looking comprehensively at the operational data, the strategic positioning, and the macro environment, the stance here is cautiously bullish for long-term investors.
Cautiously bullish. Okay, I want to make sure I am hearing you correctly here. We just spent 20 minutes detailing how their gross margins have plummeted by 190 basis points, their earnings per share collapsed by 12%, their factory utilization is sitting at a dismal 59%, and management is actively warning us that margins are going to step down even further next quarter.
All true.
And yet, the verdict is bullish.
Yes, despite the severe short-term margin compression.
No.
Because if you step back from the quarter-to-quarter algorithmic trading mentality, right, and view the business over a multi-year horizon, the bull case for Champion Homes is anchored by 2 undeniable forces.
Okay, what are they?
First, an absolute fortress of a balance sheet, and second, a tidal wave of macroeconomic and legislative tailwinds.
Let's start with the fortress because their balance sheet is frankly ridiculous for a company of this size.
It's incredible.
As of the end of December, Champion Homes was sitting on $660 million in pure cash and cash equivalents.
Yep.
$660 million. They generated $100 million of operating cash flow in this single quarter alone, despite the margin squeeze.
Exactly. And that liquidity provides them with complete immunity to the current interest rate cycle.
Right.
While traditional builders are getting absolutely crushed by borrowing costs to finance their land acquisition and construction pipelines, Champion is operating from a position of massive cash surplus.
They don't have to borrow.
Right. And that cash pile is actually about to get significantly larger.
Oh, yes. This was a major point of discussion on the call. The liquidity event involving ECN Capital.
Exactly.
Yeah.
So Champion holds a 19.7% equity stake in ECN Capital.
Okay.
ECN is the parent company of Tribes Capital Partners, which operates in the financial services sector, providing financing solutions within the manufactured housing space.
Got it.
And it was recently announced that ECN is currently being acquired by Warburg Pincus, which is a massive private equity firm.
And when a private equity firm buys a company you own 20% of, you get a very large check.
You certainly do.
What are the exact mechanics of this transaction for Champion?
Well, the transaction is expected to close in the first half of the year. Upon closing, Champion shares in ECN will be extinguished at a valuation of $3.10 per share.
Right.
When that settles, Champion will receive a direct cash infusion of approximately 189 million Canadian dollars.
Okay, let's just do the math here. They already have $660 million in the bank.
Yeah.
They are generating $100 million in operating cash per quarter.
Mm-hmm.
And they have another $189 million Canadian clearing soon.
Yep.
That is a staggering, almost incomprehensible level of liquidity for a mid-cap manufacturing company.
It is. And crucially, management is not just letting that cash sit idle in treasury bills. No, they're aggressively deploying it to benefit shareholders. During the quarter, they executed $50 million in stock buybacks.
Oh, wow. So they looked at their own suppressed stock price, realized the market was overreacting to the short-term margin squeeze, and stepped in to buy their own equity at a discount.
Exactly. They bought the dip on themselves. And beyond the $50 million they already spent, the board of directors literally just refreshed a massive $150 million share repurchase authorization.
This is the ultimate signal of internal confidence.
Absolutely.
I mean, if you hold SKY stock and you are worried about the 12% drop in EPS, the fact that management is armed with an $800 million war chest and authorization to buy back $150 million of their own stock provides an incredibly strong floor.
Right. It severely limits the downside risk.
But limiting downside risk doesn't create a bull case on its own. What creates the upside potential?
The upside potential is driven by the fact that the entire legislative environment in Washington, D.C. has suddenly aligned with exactly what Champion Homes does best.
Yes. The CEO, Tim Larson, dedicated a significant portion of his prepared remarks to discussing the federal government.
He did.
And I want to be perfectly clear here for everyone listening. We are completely impartial on this deep dive.
100%.
We do not take political sides, and we are not endorsing any specific political platform. We are just objectively analyzing the regulatory reality presented on the call. But the reality is that there is a massive, aggressive, bipartisan push at the federal level to utilize off-site construction to solve the housing crisis.
The regulatory momentum right now is unprecedented. Larson highlighted several specific pieces of legislation currently moving through the government.
Okay, let's walk through them.
First is the House Affordable Homes Act, which actually recently passed the House of Representatives.
Okay.
The primary aim of this legislation is to eliminate duplicative federal rules and explicitly reaffirm the Department of Housing and Urban Development HUD as the ultimate preemptive authority on manufactured housing standards.
Okay, but why does that matter to Champion's bottom line?
Because the biggest historical bottleneck for manufactured housing hasn't actually been consumer demand. It has been local zoning boards and fractured, contradictory municipal building codes.
Oh, local town councils blocking developments.
Exactly. By reasserting federal HUD supremacy, this legislation slashes the bureaucratic red tape, making it drastically easier and faster for Champion to place their homes in municipalities that historically fought against off-site construction.
Wow, so it legally clears the runway for expansion.
Precisely.
What else is moving through Washington?
Well, there's also the Housing for the 21st Century Act, which is currently being drafted.
Okay.
This legislation contains provisions specifically engineered to catalyze the expansion of off-site built homes.
Like what?
The most transformative element is a push to allow HUD code homes to be built and installed without a permanent steel chassis.
Okay, that sounds deeply technical, but it fundamentally alters the financial architecture of the industry, doesn't it?
It absolutely does.
Because historically, manufactured homes, what people used to call mobile homes, had to be built on a permanent steel chassis so they could be towed.
Right.
And because of that chassis, they were often financed as personal property, kind of like a vehicle, using a chattel loan, which carries much higher interest rates.
Exactly. It made financing them very expensive.
Right.
But if the federal government removes the requirement for the permanent steel chassis, these off-site built structures can be permanently affixed to a foundation in a way that makes them functionally identical to a traditional site-built home.
Meaning?
This means they can qualify for standard, traditional 30-year fixed-rate mortgages.
Wow. Which instantly lowers the borrowing costs for the consumer, vastly expanding the pool of buyers who can actually afford a Champion home.
Exactly. It's a game changer.
And the legislative push isn't just coming from Congress. During the Q&A portion of the call, an analyst specifically asked management about a new initiative being floated in political circles called the Trump Homes program.
Yes, they did.
Yeah.
Based on reports, this initiative theoretically aims to leverage private investment to build up to 1 million homes, specifically designed to boost supply and drive down costs.
And again, regardless of which side of the political aisle is drafting these proposals, the signal to the market is basically deafening at this point.
It really is.
The federal government has fully recognized that traditional site-built construction just cannot scale fast enough to solve a multi-million home deficit.
Right.
Every regulatory indicator is screaming, we need more affordable housing and we need to build in factories.
And Champion is perfectly positioned at the absolute epicenter of that mandate.
Yeah.
Management even mentioned that the HUD Secretary's team actually conducted an extensive tour of Champion's manufacturing plant in Burleson, Texas, this past January.
Wow, so they're actually walking the factory floor.
The federal government is not just writing policy, they're actively inspecting Champion's assembly lines, looking at their operations as the blueprint for a national solution.
That is a macro tailwind of historic proportion.
Without a doubt.
So let's bring all of this directly back to you, the listener. What is the actual actionable takeaway from this deep dive?
Right. What should they do?
If you are holding SKY stock, or if you are considering initiating a position, you really need to understand that the short-term margin pain is real.
It is.
But your safety net is that massive incoming cash pile and the board's willingness to execute share buybacks.
Exactly.
However, looking forward, there is one key operational metric you absolutely must watch on their next earnings call. What is the ultimate litmus test for their current strategy?
The ultimate test revolves entirely around that Q4 inventory build we talked about.
Oh.
You need to listen incredibly closely to their next update to see if that strategy actually worked.
Right.
Did the inventory they purposefully stockpiled and parked on their captive retail lots successfully translate into a massive spring selling season?
That's the billion-dollar question.
Did the cautious consumer finally capitulate, walk onto the lot, and buy the homes just because they were immediately available?
Or conversely, are those homes still sitting on the dealer lots, tying up working capital and gathering dust because the macro environment worsened and the consumer never showed up?
Exactly. If the sell-through materializes in the spring, it proves their vertically integrated captive retail strategy is a massive success.
All right, and the Q4 margin squeeze was just a brilliant investment.
Yes.
Yeah.
But if the homes sit idle, it signals that the affordability crisis has deeper macroeconomic roots that even $185,000 homes cannot fix in the short term.
Which brings us to our final lingering thought for this deep dive, something for you to mull over as you analyze this company and look at your own portfolio.
Mm-hmm.
Champion Homes is currently sitting on $660 million in cash.
Yep.
They have another $189 million Canadian clearing from the ECN transaction.
Right.
They generate immense operational cash flow every single quarter. They possess vastly more capital than they need just to keep the factory lights on, whether a slow winter season, or even execute their current $150 million buyback authorization.
It's true.
They are sitting on a dragon's hoard of capital. So what exactly are they going to do with that war chest?
It is the multi-hundred-million-dollar question. Will management take the conservative route, using the cash to aggressively buy back their own stock while the valuation is suppressed by those short-term margin fears?
Or And this is what's really interesting. Are they hoarding this cash because they are gearing up for something exponentially big?
Oh, that's entirely possible.
They just proved to the market exactly how successful the Eisman Homes acquisition was in boosting their retail margins and shifting their sales mix to 38% captive retail.
Right.
Are they piling up cash right now to acquire another major competitor?
It would make a lot of sense.
Could they use this billion-dollar liquidity wave to completely dominate the direct-to-consumer channel, aggressively buying up independent dealerships across the entire country, vertically integrating the industry, and owning the entire housing process from the factory floor all the way to the front door?
When a company possesses that much dry powder, especially operating in an industry that the federal government is actively trying to deregulate and expand,
the next major capital allocation move they make could fundamentally redefine their valuation overnight. The muddy waters of the national housing crisis might be incredibly difficult to navigate, but having a billion-dollar life raft certainly makes the ride smoother.
It definitely does.
Thank you for joining us for this deep dive into Champion Homes. Keep a very close eye on those spring selling numbers, watch what they do with that cash, and we will see you next time.